Joins us. Good morning, Suresh. Good to have you with us as always. Well, a rate cut of that magnitude and the aggression with which the Reserve Bank is saying it should be transmitted is normally not very positive for banks. How have you read the policy and its impact on banks?
Okay, so to begin with, Lata, I have a reservation with the media because I think they tend to make a mountain out of a molehill at times. I mean, look, an additional 25 basis points is what Dr. Rajan has done compared to the expectations. The expectations are 25, he has gone ahead and an additional 25. That doesn't change the economics of the game in a very big way. To begin with, from a banking sector, a rate cut is positive over the longer term because obviously that helps in kickstarting the economy. In the near term, there is going to be margin pressures across the board. The problem here is that everybody obviously has an issue of cost of funds, which doesn't come down as fast because everything is based on weighted average cost of funds and the deposit base is actually fixed. So what happens is that once you cut your lending rates, immediately you have a margin pressure. So there is going to be a margin pressure across the board for all the banks, more so for public sector banks because they have closer to about 70 to 80% of the portfolio being floating rate. So you will see earnings pressure for banks in the coming quarters.
Okay, Suresh, hi, morning. So can you quantify that for us? Because yesterday when we spoke to SBI post the base rate cut, she did mention that there will be at worst an 11 basis points cut in their margins or decrease in their margins. What are you factoring in terms of margin pressure for some of these PSU banks?
Yeah, so suppose if you end up cutting your rates by about 30 to 40 basis points and you have roughly 70 to 80% of the portfolio being floating rate linked, you can have closer to about 15 to 20 basis point compression in margins. And that's what happened with SBI, right? When SBI cut its base rates by about 30 odd basis points over the course of last 3 or 4 months, the margins actually, if you look at it on a QOQ basis, went down roughly about 15 to 20 basis points. So something similar like that can happen across the public sector banks. Private sector banks obviously are in a better position to manage, so they maybe their margins don't take a hit of more than 10 basis points.
Are all private sector banks equally kind of insulated from base rate cuts? HDFC Bank clearly is, but would that be true even of ICICI and Axis and Yes Bank?
No, not at all. So if you look at it, HDFC Bank is actually the best placed. They only have about 25 to 30% of their portfolio being floating rate. Now the corresponding number for most of the private sector banks is going to be in the range of 50% plus. So clearly base rate cut of that magnitude which HDFC Bank has done, it is very difficult for others to replicate. If they also land up cutting rates by more than 30-40 basis points, obviously they will have a greater amount of margin pressure compared to HDFC Bank. So in my opinion, HDFC Bank will continue to have the lowest base rate in the system.
Okay. What about the housing finance companies? Because they've seen the biggest gains, in terms of stock prices. The reduction of this risk weight for housing loans, how will it really impact them?
See, the rules are not very clear exactly as to what is the threshold criteria which RBI is defining for affordable housing. Now, affordable housing as a terminology is super confusing. I mean, even going by RBI definition, it keeps changing the affordable housing for different segments. For priority sector, it is 30 lakhs. For infrastructure bonds, it is 40 to 50 lakhs. For low-cost affordable housing, it is less than 10 lakhs. So really, we don't have any clue as to what exactly RBI means by affordable housing and what would be the corresponding reduction in risk weights. So unless and until we know the threshold ticket sizes, based on that we will be able to ascertain the possible impact. Note that most housing finance companies like HDFC, LIC Housing Finance, or that matter Indiabulls, most of them actually have the ticket sizes in the range of between 20 to 25 lakhs. So if that is where, and of course even the public sector banks. So if that is a segment that they are targeting where they want to give risk weights benefits, then obviously it will benefit a whole lot of players in the system.
So what are your top picks in this space?
Well, we would obviously in this environment when rates are heading downwards, clearly HDFC Bank stands out because their ability to withstand margin pressures is far higher compared to any of the other banks in the system. So HDFC Bank will be my topic, followed by Axis and Yes Bank, considering where the valuations are. We do see compelling reasons to buy these two names also.
Okay. Suresh, yeah, actually, even the word affordable housing has not been used. What Reserve Bank refers to in that capital cost reduction is low-value loans, low-value home loans. So it's an altogether different term, and I think the notification is still due. In the NBFC space, what would you like at all? After all, their sources of funds definitely get cheaper.
Yeah, that's true. But then remember, at this point in time, every NBFC is actually facing some issue or the other. So we cannot look only in isolation and say that what would happen if interest rates were to come down, and therefore whether I would like to pick an NBFC to play the theme. Because Shriram Transport has its asset quality issues. Mahindra Financial has been having asset quality issues for quite some time. So those issues are not going to disappear anytime soon. Monsoons obviously have not been that great this year. So I think the best ones to play in my opinion, in this environment would be, of course, the housing finance companies, because they're much safer bets when it comes to asset quality and obviously more leverage to the interest rate cycle. So my preferred picks in the housing finance segment, considering where the valuation is going to be LIC Housing Finance.
Okay. Because the sentiment has improved, with this 50 basis points rate cut, the expectation is that credit growth will pick up as well. What are you factoring in terms of credit growth for, many of these banks?
Well, it's going to be tough, to be honest, Sonia, that another 25 or 50 basis point is going to kickstart credit growth. We know that the key drivers behind credit growth is completely different. It's about pickup in the capex cycle, the investment cycle. That all takes time. It's not going to happen overnight. It's not going to happen over the course of next 12 months. It will take 24 to 36 months for the capex cycle to pick up. So that related recovery is not going to be seen in the credit growth. And as the SBI chairperson has been telling for quite some time, this is what we have also observed while speaking to various bank managements, is that the low commodity prices is really creating a lot of impact on the working capital demand. So working capital loan growth is actually very, very weak at this point in time. And that is the reason, it's not about 1 month or 1 week or 1 quarter where we are seeing a 9.5% kind of a credit growth. 9.5% credit growth has been there now for the past 6-7 months. And I just don't understand the logic behind base, which people argue. The point here is that we are looking at YOY numbers. So if the base was weak this year, if the base was weak even last year, so you're looking at a YOY numbers for 9.5% is a genuine number. So the seasonal aspect is something which I don't understand. So even as you head into the March quarter, last year's March quarter was also going to be pretty heavy in terms of credit disbursement. I think we are not likely to see a significant credit recovery this year. This year is gone. We are now looking at FY17 and beyond.
That's a fair point. The fall in prices is definitely leading to lower working capital demands, and of course investment demand is non-existent. But Suresh, what is the sense you are getting about the quantum of NPLs in the stressed loans in the system itself? Has most of the poison come out? Are the new weapons that the Reserve Bank has given in the form of strategic debt restructuring or taking over of companies by conversion of loan into equity and a whole host of things working at all, will work at all? Is the worst of the stress known to us?
No, look, there is still a lot more to go. We really don't know what is going to be the bottom for the steel sector, right? Our commodity team keeps cutting the steel forecast every month by 10 to 15%. So clearly, and most of these large steel players have not even been restructured. Forget about being shown as NPL. They have not even been restructured, which means that there is going to be a lot of stress coming from the steel sector at this point in time. Plus, we have been hearing quite a lot about talks about SCB reform and stuff, but then they are yet to gain momentum, right? So the power sector still continues to be in quite a lot of a mess. As latest as the quarter ago, IDFC took a massive write-down on their power sector exposures. So the private sector banks have already started taking some write-down of the exposures, which the public sector banks and many of the other large private sector banks are yet to take down. So I don't think we have seen the worst in terms of asset quality cycle. It will definitely take time. And look, RBI themselves are lowering growth assumptions.
Yes.
So we are very clearly in a declining growth environment. How can one get comfort over asset quality? That beats me. Even if rates are coming down, if growth is coming down, growth is the biggest panacea. If one were to ask me what is going to solve the problem, it is not rates. Obviously, growth is contingent on rates, but growth needs to really start showing up. And that is yet to be seen across the numbers for various banks, or for that matter, the economy.
Oh yes, that was the subtext of the credit policy yesterday, the lowering of growth, and in fact the lowering of inflation coming on the back also of lowering of growth. Suresh Ganapathy, thank you very much for joining us. It's always a pleasure listening to you. Well, that's a hard-nosed analysis of who will benefit from yesterday's rate cut. At the moment, the Bank Nifty is just clambered back to, flat terrain. The advanced declines are still slightly pleasant picture, with 4 stocks in the green for 1 in the red, and the mid-cap index for the record is still up 1%. But the market is kind of jittery at these levels. It's not standing firm at 7,900 with any emphasis. It's susceptible to repeated bouts of profit taking at those levels. So it's a jittery stand at 7,900. We'll take a break on that note.